Today I'm going to talk a little bit about trade and tariffs because it's been so important for both U.S. politics, policy, and individual businesses. So I'm going to use supply and demand to show how trade can make both producers and consumers better off in terms of their well-being. Then I'm going to show how a tariff can make one side maybe a little bit better off, but it'll make both groups as a whole or the world in total a little bit worse off. So I'm going to use supply and demand and a little bit of economic welfare analysis to show this. So I have here supply and demand for a country. You can see the equilibrium prices here. This is what it costs to produce this product. Now, if you remember, supply is the cost of doing business, and demand is the benefits to consumers. And this point is beneficial to both producers and consumers, so they sell at this price. Now, what I'm saying here is if you were to draw the economic welfare, you can draw consumer well-being, which is this triangle here, and you can draw producer well-being, which is this triangle here. So I'll draw that in red. So this is what we call producer surplus, or PS, and this is what we call consumer surplus, or CS. And this is everything lower than this line means that the benefits are higher than the costs, which is the price. The benefits are higher than the price. So the consumers actually get more benefit than they pay. That's their well-being. Supply is the cost curve. So producers actually produce for less cost than they sell for at this price, and anything where the price is higher than the cost is their profits. So producer surplus is this triangle here. All right, so this is the well-being for consumers and for producers. And this is with no trade whatsoever. But let's say that there's another country that comes along and they can do things cheaper. So they have supply and demand down here, and their price is down here. So they are the cheaper country. They produce for a lower cost. Now, trade theory can tell us, well, what causes those prices to be lower? And you could basically say it's because of technology. You could talk about labor costs, or you could talk about land costs or capital costs. And you could also talk about other advantages. You could talk about their history, their well-being, or maybe just accidents, historical advantages. But usually it's technology, labor costs, or it could be what we call factor costs, and labor is a factor. So those are kind of the two main theories. So this is cheaper for a reason. Now, you could see down here that this country gets its producer surplus and its consumer surplus here. So this country has its own market with its own benefits to producers and consumers. Now, these are both separated from each other. We're assuming they're not trading. High-cost country, low-cost country. But now, suppose that they meet and they say, okay, we're going to trade with each other. And this country would love to sell at a higher price. They could make more money. This country would love to buy at a lower price, and they could buy for less, they would benefit too. So somewhere in between is going to be a price in between where this gap here is equal to this gap here, more or less. And if you see here, this country supplies more than it buys. And what do they do with the rest? They export it. So this country becomes the exporter. And this country is able to buy more than it produces. And where does it get those products from? It imports them. And so this is what we would call two large countries. You could do it for small countries in other cases too, but you could kind of view this as the US and this is China if you wanted to. This country is going to import, this country is going to export, and they're going to be both better off. And I can show you that. I'll show you in black because that marker works better. But this country's profit, its producer surplus, now grows to be a larger triangle at a higher price. I call it PW because that is the price for the whole world. Now, this is better because their producer surplus grows. Now, what happens is their consumer surplus shrinks. Now, if we take it from the U.S. perspective, we can see it a little bit clearer. At this new higher price, for these guys, it is a lower price for the importing country. And this consumer surplus grows to be even larger. Producer surplus is now this tiny triangle. In other words, profits for the producers, jobs for producers have gone down. The total triangle size is smaller, meaning profits are lower. The producers lose. And what's going on too is that the supply within the country is dropping as well. So as this is dropping, that means fewer products are being produced in this country because they're being made over in the foreign country. This is the producers going out of business. If you think of the steel mill closing because it's too high cost to compete, that is this drop in supply here. So profits are shrinking, the quantity of production is dropping. That is bad for the producers in the importing country. But who's winning? The consumers are winning because their triangle is much, much larger. That's like saying we like to buy from the foreign countries because it's cheaper. We get high benefits at a low cost, which means our overall happiness or utility is higher. And this triangle is special because this is new. This is created out of nowhere. When people talk about trade creating welfare and creating efficiency, you could say that this triangle represents the new gains from trade that makes everyone wealthier overall. All right, so foreign producers win, home consumers win, but home producers lose. And we know what happens then. They organize, they vote, they elect people, they get laws passed, and they say, please introduce a tariff. So we're going to introduce a tariff where we add to the price. We're going to tax these imports, raise the price a little bit in this country. I'm not going to focus on this country over here right now, but I'll say what happens here. First of all, profits get a little bit bigger. These producers start to make money again. What's interesting here is that producers go back into business. You're opening up new businesses. You're bringing production home and you're increasing supply. Over here, the high price kind of discourages some buyers, so less is bought, and so the quantity demanded drops. And the new imports are smaller. That's what tariffs do. They raise the price to lower imports. So the imports are lower, profits are higher, producer surplus is higher. And look, consumers, their triangle is shrunk a little bit, so consumers are worse off. And that's something people have to remember. You tax automobiles, auto buyers can lose, even if the automakers win. And because it's all interconnected, you can't really tell who's who, because all the processes, sometimes you're a buyer, sometimes you're a seller in terms of parts and other inputs. Now, I want to focus on this right here. This little box is the tax right here. This distance up is the tax times your new imports. Right here is government revenue. Government collects the tax from consumers. Consumers are paying more. This tax is paid for by the people who buy the product. Now there's two shapes left. This triangle is lost consumer surplus, lost well-being, because consumers don't like the high price. They don't buy it. Anytime you don't buy something you wish you could have bought, you're less happy. This is a loss to consumers. But this one right here is important. If you produce something at a higher cost than you used to need, you're producing something at a higher cost. You're in effect wasting resources to make the same thing. This triangle means you're making things, this quantity is what you're making at home, at a higher cost. That's a cost that used to be made cheaper somewhere else. In a sense, this is the resource cost, the lost efficiency due to making it yourself instead of importing it cheaply. So these two triangles are lost to the world. Trade makes both sides as a total worse off. So to kind of recap, trade brings the price down and makes consumers much better off and brings this big triangle, but the tariff cuts it up, gives some of it to the producers. That's the producers making more profits as they go back into business. The government collects some money, but both consumers and producers are worse off. So when people talk about trade policy, they have to keep in mind producers win, but other sides might lose as well.